All right, let's set the scene. It is February 23rd, 2026, and the entire global economy is just holding its breath. We've got two massive, and I mean colossal, opposing forces that are on a collision course. And honestly, the outcome is going to define everything for the rest of the year. So, let's break down what's happening.
So this is the big question on everyone's mind for the rest of the year, right? You've got these two incredibly powerful, totally different forces hitting the global markets at the exact same time. Which one is going to win out? The answer isn't just about your portfolio. It's about the very structure of our global economy.
And here it is, the core conflict laid bare. On one side, you have a political storm, a very top-down policy of protectionism, all driven by this new global tariff. And on the other side, a technological earthquake, a bottom-up wave of innovation from something called agentic AI, and it's promising to completely rewrite the rules of business. It's an epic showdown, politics versus technology, centralized control versus decentralized innovation.
Okay, so first up, let's dig into that political storm. And let me be clear, we're not just talking about a tweet here. This is a formal policy shift with absolutely huge consequences for global trade.
So, you might be wondering, how did we even get here? Well, after other paths were blocked by the Supreme Court, President Trump reached for a powerful but not often used tool, Section 122 of the 1974 Trade Act. This basically lets him impose a temporary, sweeping 15% tariff on, get this, all U.S. imports. I mean, all of them. It's like throwing a massive wrench into the gears of the global supply chain.
And for anyone who studies market history, this move feels a little too familiar. A lot of analysts are drawing a straight line from what's happening today all the way back to the 1971 Nixon shock. That was another time the U.S. acted alone on trade, and it destabilized the dollar and kicked off a really painful period of stagflation, that nasty combo of high inflation and zero economic growth. The big fear is that history is about to repeat itself.
The fallout? Well, it's pretty much immediate, and it's not pretty. Supply chains get totally messed up, which of course pushes prices higher. The risk of that stagflation we just talked about becomes very, very real. You can pretty much guarantee trade disputes with key partners like the EU. And maybe the biggest deal of all, this kind of stuff chips away at the trust that makes the US dollar the world's go-to currency.
But okay, while all that political drama is unfolding, there's another force gathering steam, and it's pulling in the complete opposite direction. This is the technological quake we mentioned, and it's not being driven by policy, but by code.
Now, we need to be super clear about what agentic AI really is. This isn't just the AI you've been playing with to make funny pictures or write emails. This is a giant leap forward. We're talking about autonomous agents. They don't just suggest things, they actually do them. They can handle complex, multi-step tasks, manage entire workflows, and start to replace high-level white-collar work at a huge scale. This is all about boosting efficiency and driving costs down, the exact opposite of what a tariff does.
And listen, this isn't some far-off theoretical idea. It's happening right now. Just look at this chain reaction. First, an AI company called Anthropic releases a tool that can automatically update all that ancient but critical COBOL code that so many big institutions still run on. The very next day, bam! IBM, whose whole business model relies heavily on servicing those old systems, sees its stock tank by 13%. Then, consulting giant McKinsey says it's deploying 20,000 AI agents. That's one for every single human consultant they have. This is creative destruction playing out in real time.
So when you have this much power, you also have this much uncertainty. The market is desperately trying to figure this out. Is this the next industrial revolution? Or is it just the next dot-com bubble waiting to pop? Well, the analysis suggests the answer is kind of both.
See, the key thing to get is that the AI sector is splitting in two. Think of it like a gold rush. On one side, you have the folks selling the picks and shovels, the hardware, the chips, the data centers. That area is seeing a ton of investment, a lot of it fueled by debt, and it feels very, very bubbly. But on the other side, you've got the actual applications, the software that uses all that hardware to slash costs and totally transform businesses. That's where the real, provable value is being created right now.
And the numbers actually back this idea up. By running thousands of simulations of what the economy could do, analysts found a whopping 82.4% probability of what they call market bifurcation. Now, in plain English, that just means the market isn't going to rise or fall altogether. Instead, a small group of companies that truly master AI are going to dramatically outperform pretty much everyone else. It's shaping up to be a real winner-take-most world.
Okay, so we've got the big picture. Tariffs clashing with technology.
Now let's zoom in. What does this all actually mean for specific markets around the world for the rest of 2026? Let's get into the forecasts.
But before we get into the specifics, we have to talk about volatility, because there's going to be a lot of it. The models that are designed to predict market turbulence are flashing a big warning sign. Basically, the shocks that are hitting the system right now, like these tariffs, they're not going to just fade away in a few days. They stick around. We're looking at months of high, sustained volatility. So I guess the theme for the year is, buckle up.
So here's the breakdown, region by region. In the US, you can expect a really rocky first half as the tariffs start to bite. The S&P 500 could even see a dip down to around 6,400 before hopefully recovering later in the year. The Fed will likely hit pause on rate cuts, and oil could spike. Over in Europe, they're going to get hit hard by these tariffs, especially their car and luxury goods makers, which might force their central banks to cut rates even as the US stays put. China, they'll probably fight back with domestic stimulus, which could actually give their tech sector a boost. And Korea could see a dip, but then a really strong rally as they forge new trade deals that go around the US.
Now, when it comes to currencies, it is all about that split in policy between central banks. The euro is probably going to weaken against the dollar since the US Fed and the European Central Bank are heading in different directions. The Korean won might spike up to 14.20 against the dollar at first because of tariff fears, but then it could actually get stronger later in the year as its export economy flexes its muscles. And the Japanese yen? Oh man, it is caught in this crazy tug-of-war between being a safe haven and those interest rate differences, so expect some wild swings. And keep an eye on China's central bank. They are going to fight tooth and nail to defend that 7.3 level for their currency.
Okay, that is a lot to take in, I know. It's complex, it's contradictory, it's messy. So how do you even begin to think about navigating all this? Well, the analysis points to a specific way of thinking, a framework for making sense of the chaos. It's called a structural barbell strategy. And hey, super important disclaimer here, this is an analytical model, not financial advice, okay? But the idea is pretty cool. Imagine a barbell. You've got the heavy weights on the two ends and not much in the middle. That's the idea. You focus on the two extremes that could thrive in this mess. On one end of the barbell, companies that are actually using AI to make real money. And on the other end, countries that are building brand new trade networks that sidestep all the US tariff drama, like the new partnership between South Korea and Brazil. The framework suggests looking for strength at these opposite poles and avoiding all the turbulence in the middle.
And so that brings us right back to the ultimate question for the year. We have these two giant forces. One is deflationary, innovative, and global. The other is inflationary, protectionist, and nationalist. So which one wins? Will technology's creative power just blast through the old walls of politics, or will politics manage to put the brakes on this new tech revolution? The answer to that is going to shape our world for a long, long time, well beyond 2026. Thanks for watching.